to Quickshots.
Welcome to the Quickshots with your favourite cousins, James and Alex Fitzgerald.
Oh.
And we're live, ladies and gentlemen. We are live.
I love it
Alex
when we're live.
is in the Gold Coast studio here with me. What a treat.
Live but not alive. I gotta
Live
say.
but not alive.
Not feeling alive.
And worn your green top right in front of the green screen yet
Always.
again. Your go-to move.
She's a lady of consistency. What can I say?
Okay, let's hook in. This is, by the way, where we answer your questions that
yes.
you send in. And I'm going to kick you off here with Brock, who sent this one via the gram. Brock wants to know, he'd be curious for us to discuss what would be the long-term effects should we be able to access $50,000 from our super fund to use to buy property instead of keeping it in there. Now, we did get this one prior to election day. This was a Liberal policy that didn't get up. So I guess we're talking in hypotheticals, but we'll discuss it anyway.
It's a good conversation to have though, right? It's a good combo.
It is, it is.
Well, you know, the panic here was, kids are taking 50 grand out. What about when they go to retire, they're 50 grand less? Well, yeah, you'll have 50 grand less, I suppose, in your super. But outside of your super, if you bought smartly, and bought well. So I've got to preface by saying if you bought a property for yourself to live in using your 50 grand plus your other savings and it was in a high growth area, so high growth meaning near good public transport, infrastructure being built, jobs and good population growth, then you will pretty much, in my opinion, you will not only outperform your super, even if by a little bit, but you'll also provide yourself with a place to live. So figure out how much it will save you in rent over that time. The average rent's about $400 a week. So over 2 years, you would have saved 2 years of rent by your 50 grand, parking it in a property. The average super fund seems to have averaged a return of about 8.2% per annum over the last 29 years. By comparison, the average capital growth rate on the Australian median house price is about 9%. So that's before CPI on both. So you're actually slightly ahead. But of course, you've got to buy the right property. Cuz, anything you want to add to that?
Well, I guess you can leverage the return with the property as well. So you are getting a 9% return on the total property, but you're only putting in 10% of the price. So I think you're right. It's certainly not going to do any worse than what it would in the super fund, particularly if it's tax-free, as you say, which the own home is. I thought it was a great policy. It's a shame it didn't get up and that they left it so late in the piece.
They both did, though. They both did. I don't think this is the policy that got either of them over the line. Well, not over the line.
Labor have said that they will take on any policy from anyone that they think's got good merits. So maybe they'll see the positives to this one.
Well, they can't come up with their own policies, so they got to let the kids write them. Anyway, let me ask you this one. This is from Coogan. Coogan, how can we get positive cash flow from an investment property?
Yeah, great question. We talk about cash flow a lot and we probably don't explain it. So what it is, cash flow is the income less the expenses. But there's two parts to that. There's obviously the rental income that you can get from a property. And then you've got to net that out from all of the expenses, such as maintenance, your property manager, your rates, water, and interest being the big one. But that's the pre-tax cash flow. At the end of the year, you get a tax refund if you're able to depreciate the home as well, which is a non-cash expense. It's just a paper loss is what they sort of refer to it as. So it's good to be positive cash flow on both fronts, pre-tax and after-tax. So if you can try and find, Coogan, a way to be pre-tax and after-tax cash flow positive, that's when I think you are knocking it out of the park.
The sweet spot, if you will.
Correct. Jagdeep, he says he's from Sydney, comes through on the email, would like to know, I'm living in Sydney and I want to know, is Sydney still a good place to invest? Assuming he means property.
Yeah. If not, Jagdeep, you've written into the wrong podcast. The answer is yes. But you've always got to take a long-term view. Always, always, always in real estate. There'll always be a day in the sun if you've bought land, right? So not just land by itself, but land obviously with a house, which will be your income component. But Sydney is actually very interesting because even though it's got your $1.4 million median house price. It's exceptionally expensive. It is going to be it is the most populated city in Australia today, and it will be still for the next 9 years until Melbourne overtakes it. But also, you've got this massive connection between Sydney and Parramatta. We actually on our company webinar this week, we had the infrastructure king, is like what I like to call him, Tim Malone from Urbis, talking about how they're going to make that the route from Sydney CBD to Parramatta 25 minutes on the train. So I do believe Sydney is still a good investment. We always look for cash flow and also growth. The cash flow side for Sydney is a little bit hamstrung right now because you're paying quite a lot and your rental yield is not very high. It's probably not where I would be buying, and I am not buying today because there are better opportunities. But I think Sydney, if you're buying to live in, is still a good investment, but you have to be looking long term. Cuz, have I missed anything there that you would like to add?
No, I couldn't agree more. It's the biggest city in Australia. It's the financial capital, isn't it?
Yeah,
and I think too, when international borders open, and they're going to open at some point, Sydney's going to be the main recipient of that. Going to get a lot of wealthy individuals from overseas come into that city. The downside, as you say, is cash flow. So I guess, I agree with you. I think it's a good place. There might be better places to invest, but I certainly, Jag D, wouldn't be selling if I've got something in Sydney at the moment. And I'd have no hesitation buying my own home in that market if that's the context in which you were asking that question.
Always. What do we always say? Do your numbers and think long term, right? So if you do those two things, it's only a matter of time until the cycle comes back around again. It could take 10 years. It took 10 years for Sydney, by the way. They saw bloody no growth from like 2002 through to bloody 2012, 2013, and now they've gone gangbusters. So it's just time in the market. See those cycles through.
Guys, we love hearing from you. We love that you recommend us to all of your friends as well. We're getting increasingly questions on the Instagram, so give that a bit of a follow.
I don't have access. Follow us and not just ask us questions?
I don't have access to it at the moment. I've mistakenly said I was 2 years old and Instagram's banned it from my account, but I'm getting the questions sent through anyway. So look, thank you very much for joining us today. It's been great to have you in person, Alex.
Nice, cuz.
Give us a follow, recommend us to your friends, and we'll see you next week.
And make good choices always. Make good choices. Thanks for listening to another episode of The Double Shot with your favourite cousins, Alex and James Fitzgerald. If you've got a burning question or something we absolutely need to talk about on the pod, please write to us. Both of our emails are in the show notes. For little real estate tidbits and a little bit of banter, a lot of banter, you can follow us on the gram. Our handle is thedoubleshot.podcast. That, my friends, is thedoubleshot.podcast. Until next time, think of us when you sit back and sip your next double shot.